Imagine waking up to discover that your biggest financial worry has transformed into your greatest asset. For thousands of UK companies sponsoring defined benefit pension schemes, this isn't a dream, it's the remarkable reality of 2025. After decades of sleepless nights over pension deficits, corporate Britain finds itself sitting on a treasure trove of surplus funds worth hundreds of billions of pounds. The tables have turned in the most dramatic fashion, and the implications are staggering. Welcome to today's deep dive into one of the most significant financial transformations of our generation. We're talking about defined benefit pension schemes, those traditional gold-plated pensions that promised workers a guaranteed income in retirement. For years, these schemes were seen as millstones around companies' necks, draining resources and threatening balance sheets. Now, according to the latest analysis from XPS, a leading pensions consultancy, DB pension surpluses have surged to record highs, climbing by an extraordinary £65 billion year on year. That's not a typo. £65 billion. To put that in perspective, that's more than the entire GDP of some countries. So what's behind this astonishing turnaround? Why does it matter to you, even if you're not a pension trustee or corporate finance director? And what happens to all this money? Those are the questions we're going to answer today. And the answers might surprise you, because this story isn't just about numbers on a spreadsheet. It's about the future of retirement security, corporate strategy, and potentially what happens to your own pension. Whether you're an employee wondering if you'll ever see a penny of this surplus, a shareholder curious about potential dividends, or simply someone interested in the massive forces reshaping our economic landscape, this affects you. So let's dive in. To understand where we are, we need to understand where we've been. Defined benefit pension schemes, often called final salary schemes, were once the gold standard of retirement provision in the UK. If you worked for a large company or in the public sector, chances were you'd retire with a pension based on your salary and years of service. The employer bore all the risk, and employees could sleep soundly knowing their retirement was secure. But then things started to go wrong. As people began living longer, the cost of paying pensions for 20 or 30 years of retirement instead of 10 or 15 started to mount. Investment returns disappointed. Interest rates fell through the floor after the financial crisis, making it more expensive to meet future pension promises. Companies looked at their pension schemes and saw growing black holes on their balance sheets. By the early 2000s, pension deficits had become a corporate crisis. Thousands of companies closed their DB schemes to new members, then to future accrual altogether. Some household names collapsed partly under the weight of their pension obligations. The Pension Protection Fund was created to rescue members of failed schemes, but even this safety net couldn't prevent significant benefit cuts for those affected. For nearly 2 decades, the story of DB pensions in the UK was one of managed decline, damage limitation, and financial pain. Fast forward to today, and the picture couldn't be more different. According to XPS, which tracks the pension positions of the UK's 7,000 largest DB schemes, aggregate surpluses have reached unprecedented levels. The consultancy's analysis shows that these schemes are now, in aggregate, sitting on surpluses that have increased by £65 billion compared to the same period last year. This follows years of steady improvement in funding positions across the sector. The total estimated surplus across these schemes now stands at well over £200 billion. To be clear, not every scheme is in surplus. Some are still fighting deficits, and the distribution is uneven. But the overall picture is one of extraordinary financial health, a complete reversal from the crisis years. Several powerful forces have converged to create this remarkable situation. First and foremost are interest rates. After more than a decade of ultra-low rates that made pension liabilities balloon, central banks began raising rates aggressively to combat inflation. Higher interest rates mean that the present value of future pension promises falls. It's a technical point, but the impact is huge. When you're discounting future payments at 5% instead of 2%, those liabilities shrink dramatically on paper. Second, many schemes have been following sophisticated de-risking strategies for years. They've gradually shifted investments away from volatile equities toward bonds and other assets that more closely match their liabilities. This liability-driven investment approach means that when interest rates rise, both their assets and liabilities move in tandem, protecting their funding position. Some schemes have benefited enormously from getting this strategy right. Third, companies have been pouring money into their pension schemes for years. All those deficit repair contributions, the cash that businesses diverted from investment and dividends to plug pension holes, has built up substantial assets. Combined with reasonable investment returns, this has created a solid asset base. Fourth, demographic changes are starting to work in schemes' favor. As DB schemes are now largely closed, they're maturing. More members are drawing pensions than accruing new benefits. While this means paying out benefits, it also means liabilities are gradually running off. The future liability tail is getting shorter. Finally, there's been an element of good fortune. Schemes that maintained equity exposure have benefited from strong stock market performance in recent years, particularly in U.S. markets. Those that hedged inflation risk before the inflation spike of 2022 and 23 avoided a nasty shock. So schemes find themselves flush with cash. This raises a fascinating question. What happens to all this money? Can companies simply raid the pension pot to boost their own finances? Can scheme members expect better benefits or early retirement incentives? The answer is complicated, and it's where things get really interesting. Under UK law and regulation, pension scheme surpluses can't simply be lifted out on a whim. The money is held in trust for the benefit of scheme members, and trustees have a legal duty to act in members' best interests. However, surpluses can be accessed by sponsoring employers under certain circumstances, and this is becoming an increasingly hot topic. Some companies are exploring options to extract surplus funds, subject to trustee agreement and regulatory approval. This might involve returning cash to the company, which could then be used to pay dividends, invest in the business, or strengthen the balance sheet. However, this typically requires member consent or meeting strict legal tests, and it's not straightforward. Other schemes are using surpluses to enhance member benefits. We're seeing some schemes offering generous early retirement terms, improving pension increases, or providing one-off enhancements. Some are even considering reopening to new accrual, though this remains relatively rare given the risks involved. A growing trend is using surpluses to buy out liabilities completely. Schemes are approaching insurance companies to purchase bulk annuities, transferring all risk off the company's books forever. Surpluses make these transactions more affordable and attractive. The insurance buyout market is booming partly because of improved funding positions. Some companies are taking a more cautious approach, viewing surpluses as a buffer against future volatility. After all, interest rates could fall again, markets could crash, or people could live even longer than expected. Maintaining a healthy surplus provides breathing room and security. For employees and pensioners, the implications of these surpluses are significant but often frustrating. If you're a member of a scheme in surplus, you might reasonably wonder whether you'll benefit. The answer depends on your scheme's rules, your trustees' decisions, and your employer's approach. Some members are seeing improvements to their benefits, particularly around inflation protection or discretionary increases. Others are being offered attractive early retirement packages as schemes look to reduce their liabilities. However, many members are seeing no direct benefit at all, watching as surpluses are used for buyout transactions or potentially returned to employers. This has created some tension. Members who made sacrifices during the deficit years, perhaps accepting lower pay rises or reduced benefits, feel the surpluses should benefit them. Employers argue they bore the risk during the bad times and deserve to benefit during the good times. It's a genuine conflict with valid arguments on both sides. For pensioners specifically, surpluses might offer improved inflation protection. Many pensions have caps on inflation increases, but trustees might use surplus funds to improve these. Some schemes are providing one-off payments or bonuses. However, these decisions are entirely at trustees' discretion and vary wildly between schemes. From a corporate perspective, pension surpluses represent a remarkable turnaround in fortunes. Companies that spent years making massive deficit contributions, constraining their financial flexibility, suddenly have options. Some are extracting value where possible. Others are using surpluses to complete buyout transactions, removing pension risk entirely from their balance sheet. The impact on company valuations can be significant. A company with a large pension surplus has a valuable asset that might not be fully reflected in its share price. Some investors are specifically targeting companies with undervalued pension surpluses, seeing them as hidden value waiting to be unlocked. However, accessing surpluses isn't always easy or advisable. The regulatory hurdles are high, the trustee relationship is crucial, and the optics of extracting surplus while members see no benefit can be terrible. Companies are treading carefully, mindful of reputational risks and employee relations. The regulatory landscape around pension surpluses is complex and evolving. The pensions regulator keeps a close eye on surplus extraction, ensuring it doesn't compromise member security. Recent consultations have explored how the regime might be updated to reflect the new reality of widespread surpluses. There's a policy debate about whether the current rules strike the right balance. Some argue they're too restrictive, preventing efficient capital allocation. Others say they're essential protection against corporate raiding of pension pots. The government is watching closely, aware that these surpluses could be mobilized for productive investment if rules were relaxed, but wary of undermining retirement security. Tax treatment is another consideration. Surpluses returned to employers face significant tax charges, which can make extraction unattractive. This is partly by design, to discourage companies from treating pension schemes as corporate piggy banks. However, some question whether these tax barriers should be eased to promote more efficient use of capital. Looking ahead, the question is whether these surpluses will persist or prove temporary. Much depends on economic conditions. If interest rates remain relatively high, surpluses are likely to be sustained. If rates fall sharply, some surpluses could evaporate. Equity market performance will matter for schemes with significant growth asset exposure. The insurance buyout market is likely to remain busy. Many companies will use their improved funding positions to de-risk completely, transferring their schemes to insurers. This is probably the endgame for most DB schemes in the private sector, and surpluses are accelerating this journey. We might also see more innovation in how surpluses are used. Could they fund new defined contribution top-ups for younger employees? Could they be used for corporate sustainability investments with trustee oversight? Could schemes become active participants in infrastructure or social housing investment? The possibilities are intriguing. There are also broader economic implications. £200 billion or more locked in pension schemes represents capital that could potentially be deployed more productively. If even a fraction could be mobilized for business investment while protecting member benefits, the economic impact could be significant. This is why policymakers are interested in the issue. For most individuals, the key question is simple. If you're a member of a DB scheme, what should you do? First, find out your scheme's funding position. Your annual statement should indicate whether your scheme is in surplus or deficit. If details are unclear, trustees should be able to provide information. Second, understand your scheme's rules regarding surplus. Can members benefit? Under what circumstances? What's happened to surpluses in the past? This information should be available from your trustees or scheme administrators. Third, engage with trustee elections and member communications. Trustees make decisions about how surpluses are used, and member-nominated trustees represent your interests. If you care about what happens to any surplus, make your voice heard. Fourth, be realistic. While surpluses are real, they may not translate into higher benefits for you. Much depends on scheme rules, trustee decisions, and employer negotiations. Don't count on surplus sharing unless it's been specifically promised. Finally, remember that a well-funded pension scheme is good news regardless of whether you personally benefit from any surplus. It means your benefits are secure, your scheme is unlikely to enter the pension protection fund with benefit cuts, and your retirement income is protected. After years of worry about deficits, that security has real value. The transformation of UK defined benefit pension schemes from basket cases to sources of surplus is one of the most remarkable financial turnarounds in recent history. The £65 billion year-on-year increase in surpluses identified by XPS represents not just numbers on a balance sheet, but a fundamental shift in the retirement landscape. For companies, it offers financial flexibility after years of constraint. For trustees, it provides options to enhance security or benefits. For members, it brings reassurance even if direct benefits are limited. For policymakers, it raises questions about how capital might be deployed more productively while protecting retirement security. The story of pension surpluses is far from over. How these funds are ultimately used will shape retirement outcomes for millions of people and influence corporate Britain for years to come. Will surpluses be returned to companies, used to enhance member benefits, deployed in insurance buyouts, or perhaps some innovative combination we haven't yet imagined? What's certain is that the days of pension schemes being corporate millstones are, for now at least, behind us. The black holes that threatened company balance sheets have become potential treasure troves. After decades of bad news, DB pensions are finally delivering good news. Whether that good news translates into better outcomes for everyone involved remains to be seen, but it's a remarkable position to be in. As we've explored today, this isn't just a technical pension story. It's about promises made and kept, about risk and reward, about how we provide security in retirement, and about where hundreds of billions of pounds of capital should sit in our economy. Those are questions that affect us all, whether we're pension scheme members or not. The pension surplus story will continue to develop, and it's worth watching closely. Because in the intersection of demographics, economics, regulation, and corporate finance, there are lessons for all of us about long-term thinking, risk management, and the surprising ways financial fortunes can reverse. Sometimes, against all expectations, the biggest problems can become the biggest opportunities. And right now, that's exactly what's happening with Britain's defined benefit pension schemes.